So before we proceed with the fixed assets, we need to understand the definition of fixed assets. What is a fixed assets, and why do we have a separate module for fixed assets, and what is the significance of the fixed assets? So this is the definition for the fixed assets. A fixed asset is a long-term tangible piece of property that an organization owns and uses in the production of its income, and it is not expected to be consumed or converted into cash in the near future. So all those assets are all those things which are used in your organization and which are helpful or which helps you in generating revenue in your business. Those are called fixed assets. So example could be land and buildings, plant and machinery, your vehicles, your software, your hardware, your computers, laptops. Okay, all those things are called fixed assets because they will help you in generating revenue for your business. So obviously without your land and buildings you cannot set up your organization, right? Your organization should be what do you call should be established in one particular building. Okay, furniture and fixture is also an example. Obviously your furniture helps you in running your business. I mean, they may not be directly helping you in generating your income, but indirectly they are helping you in running your business. Without furniture, then how do you run your business? Like without your furniture and fixtures, I mean, if there is no fixtures includes your AC and fans, then how can your employees then work and how can they generate revenue? Similarly, the furniture, vehicles, if you got your own company vehicles which are used in transporting your goods or which are used for transporting your employees or commuting your employees, then they are indirectly helping you in generating revenue for your business. So all those things are called fixed assets, and as per law you need to create those fixed assets in the fixed assets module and charge something called depreciation. So in accounting terms, depreciation is nothing but reduction in the face value of an asset because of use or wear and tear. So that's the definition of depreciation. Whenever you use an asset, obviously over a period of time the value of the asset gets depreciated. So take an example, you purchase any kind of a vehicle or you purchase any kind of a laptop or something like that. You purchase a vehicle today. Do you expect for say $20,000 or 20,000 whatever, $20,000 or 300,000 rupees? Do you expect to get the same value when you try to sell that particular asset after 1 year or 2 year? No, because there is a reduction in the value of an asset because of usage of that particular asset. So that particular reduction in the value of an asset because of usage or wear and tear is called depreciation. And for all the fixed assets, law allows us to charge depreciation on the fixed assets, and whatever the depreciation which is charged on the fixed assets can be moved to a P&L account, and that will help you in reducing your tax. Let me just open a running sheet for fixed assets. So take an example in your organization, your entire revenue for one financial year is say 100,000 rupees. Okay, your expenses is say 40,000 rupees. So what is the net profit of an organization? 60,000. Your income minus your expenses incurred in running your business is 60,000. Okay, so in a normal world you need to pay tax on this 60,000 rupees. Okay, but when you charge a depreciation on your fixed assets, so depreciation is not exactly kind of a physically you are spending some cash. You are actually calculating depreciation on asset based on certain rates. We'll get into those details in a while. So take an example, there is an asset which you are purchased in the organization, and that value of the asset is say 50,000 rupees, and you charge a depreciation of 10% on the particular 50,000. So 10% on 50,000 is 5,000. So whatever the depreciation you charged on your fixed asset, you can claim that as an expense in your books of accounts. So that means now what you are doing is, instead of saying your expense as 40,000, you are saying your expense as 45,000. So if you say your expense is 45,000, your net income has got reduced from 60,000 to 55,000. So now you are obviously paying less tax. So earlier on 60,000, let us assume on 60,000 you are paying say 30% tax, which is 80,000, 18,000. Now as your profit reduced to 55,000, you will be paying only 30% on 55,000, which will be 16,500. So indirectly you are saving 1,500 rupees because of this particular depreciation. Is that clear? Whether the concept is clear, what is depreciation, and what is the reason for charging a depreciation on the fixed assets, and where do you show the depreciation in P&L account, and what is the benefit for the organization?
Yes, sir.
Yeah.
Yes, sir.
Okay. So as far as the fixed assets is concerned, and also there is one more thing uh, before we proceed with the fixed assets.
Hey, one thing, Arvind, fixed assets is basically only in terms of the depreciation calculation, or can we make a determination of how many assets you have and everything also, which is there any other aspect other than depreciation meant for
Okay.
a fixed asset?
Okay, so one aspect is depreciation. So how can you calculate depreciation in fixed assets? Based on the assets, whatever is recorded in the fixed assets. Okay. So obviously, if the assets are recorded in fixed assets, then obviously you can run even the reports out of fixed assets to find out how your assets are looking like. How many assets you have, what is the what do you call the cost of those assets, and whatever the additions which you have made. There are a lot of other things. So there are two aspects. One is maintaining of an asset register, which will have the details of all the assets in your organization. Second thing is charging of the depreciation on those assets.
Okay.
Okay. So generally, as I mentioned earlier, all your subledgers, your accounts payable and accounts receivables, purchasing, and those subledgers are actually stored at the operating unit level. Inventory module is stored at a kind of an inventory org level. General ledger is stored at the ledger level. Similarly, your fixed assets is also stored at a something called FA ledger, and that particular FA ledger is actually linked to the corresponding GL ledger. So you can say your FA module is also at a ledger level. So for FA, we do not have a significance of your operating units are a kind of a legal entity. FA is always at your ledger level. And in fixed assets, we have got something called corporate book and tax book. There is one more book called budget book. We will not get into those things. I have never used any client using this budget book functionality. But these are the main two books: corporate book and tax book. So what is corporate book and tax book? Whenever you create an asset in GL, when you are creating a kind of a journal, you select the ledger name. Similarly, in your subledgers, when you are creating a transaction, you select the appropriate operating unit, or operating unit will be automatically defaulted based on the responsibility whatever you are using. Similarly, in your fixed assets, whenever you are entering a transaction, you should select something called a book. Okay, so that book can be a corporate book or it could be a tax book. So what is corporate book and what is a tax book? Every country has got something called corporate law or company law and tax law or income tax act. So corporate book is governed by something called Companies Act, and tax book is governed by something called your tax income tax act. Take an example, or India or US or Australia or your Europe or any country or Malaysia or any country, you have two laws: corporate law and tax law. So every country which has got this corporate law and tax law, okay, they says that depreciation calculation should be on a different basis. So there could be one asset, say asset could be your building, okay, which you have purchased for say 100,000 rupees. Okay, your corporate law can say that the depreciation charge on 100,000 rupees should be say 10%, and there is something called a depreciation method which I'll come in a while. Like a depreciation method is straight line or net book value method. Okay, just at a high level, your corporate book can say that your building for a building of 100,000, your depreciation rate should be say 10%. Your tax law say that for the same asset, your depreciation rate could be say 5%. or it could be even say 15%, depending on the tax rate whatever they have actually published. Okay, so how is it possible to calculate two different depreciation rates on an asset? It is possible by maintaining the assets in the corresponding books. So what we do as a normal process, we add an asset in corporate book. That is when you are doing a data entry, you select the corporate book, okay, add an asset and perform the depreciation. And then at the end of the month, you run a program called periodic mass copy. That particular program will copy all the assets whatever you have created under the corporate book, only assets, not the depreciation calculation. Okay, all the assets whatever you have calculated in the corporate book, created in the corporate book, and they will pass on that particular information to the tax book. And then at the end of the month, once you run that periodic mass copy program, your assets will be available in the tax book, and then you run the depreciation program again in the tax book, and then you will be able to see the calculations. Okay, so in this case your depreciation will be 10,000. So in this case your depreciation will be 15,000. Okay, and in general I'll also get to those details in a while. All these depreciation calculations or asset calculations or asset additions will be transferred from your fixed assets module to general ledger. Like any other subledger, whatever the transactions which you enter in your subledger should be posted to your GL by running a program called create accounting. You will do the same thing even in the your fixed assets module. Okay, you will do that particular process of running of create accounting and pushing the data to GL only for the corporate book. You will not do that for the tax book. And there is a setting, I'll show you that particular setting which will stop you from pushing the data of tax book to GL. Can anybody explain me why is that we are not pushing again tax book data to GL? Okay, the reason being we have already pushed the asset details as well as the depreciation details from corporate book. If you again push the details from tax book, then it will be duplicate. Obviously, you do not want to do a duplicate accounting. You want to do an accounting only once. So this data will be pushed to GL, and this particular data will be used only for a reporting purpose, and they will use this particular data for the tax calculations. So whenever you are arriving at this particular tax calculation, whatever I said that, so here the depreciation amount I have taken in this example is 5,000. So if you take this example, the depreciation is not 10,000, the depreciation will be 15,000. So you do this particular calculation offline, and when you are doing an offline tax calculation, you consider the depreciation as per your tax book and arrive at your depreciation amount. You do not consider your depreciation as per your corporate book, as far as the tax books calculation is concerned. And from an accounting perspective, you still continue on these things. Any questions here?
Yeah, Arvind, so if you are using the corporate book for accounting purposes, and tax book is basically for tax calculation, and that is what you pay to the government, right?
Mm-hmm.
So in that case, then there is a disconnect between the numbers that you show in GL and the actual tax that you pay to the government, right?
There is no disconnect. I'll explain you.
Mm-hmm.
See, this is your income, okay, and this is your income, and this is your expenses excluding depreciation. 40,000. Okay, so if you look at your any income statements of any large companies, you will be able to see income, expenses excluding depreciation. Okay, and it says net profit before depreciation, 60,000. Okay, depreciation as per tax book, or they just say depreciation, but internally they are considering depreciation as per tax book, which is 15,000. Okay, and your net profit after depreciation is 45,000. You arrive at the tax amount on 45,000, which is 45,000 into say 30%, and you pay tax to the government on 13,500. So all these details, whatever you're doing, is just like kind of an outside the system. You're doing this particular calculation. There is no disconnect, and that's what even the law says that as far as the you are paying tax as per your income tax act. So when you're paying tax as per your income tax act, show me the depreciation calculation as per my income tax act, not as per your corporate law. So the depreciation calculation as per your income tax act in this example is 15,000. So you are showing that particular 15,000, calculating this is your net profit after depreciation, and outside the system you are doing this particular calculation and arriving at that particular figure and paying that particular amount to your income tax department. And once you have paid that particular 13,500 to your income tax department, again in your GL you pass an entry like your tax account debit 13,500 and your bank account credit 13,500, bank or cash account. So that's the journal entry which you pass whenever you are making a payment.
Right. Um, uh, so ideally, the income and expense excluding depreciation and net profit are coming from GL, right?
Yes.
Right. And the depreciation as per tax book is coming from FA tax books.
It is not coming. You are actually, as I said, that this is actually a kind of a calculation outside the system, or you do this kind of calculation manually in FSG reports. Also, you can do that. Okay. So as far as the depreciation as per tax book is concerned, you will not be able to derive that particular value from the tax book because your FA tax book is not sending the data to GL. You run some reports, grab that particular value and pass that particular value here or enter that value here.
Okay, and this is all done outside of the system, right? Not within the system somewhere.
Exactly. Yes. No, I have not seen any company who is doing the tax calculation in the system. I mean, they run some kind of a reports. They build some FHG reports. At least, I mean, you can build some FHG reports to come up to this particular stage. Okay, bring up all your incomes, show me all your expenses. Okay, show me your net profit, and you can use this particular value and then do these kind of calculations. Okay, and also obviously the tax rate, I just taken a simple example of 30%. There are so many different slabs, there are so many different terms and conditions which comes into picture. It is not directly possible to do that particular tax calculation in your Oracle.
Okay, and not even in the EB tax, is it?
The EB tax is not for income tax calculation. EB tax is totally EB tax is called something called your indirect tax solution. So tax is divided into two categories: direct tax and indirect tax. So direct tax is basically your personal income tax, whatever you're paying to the government. So that is this. And EB tax or vertex or sabrix, these are the different solutions. And EB tax is called indirect tax. So whatever the indirect taxes, that is your VAT, GST, and everything, whatever you are paying on your goods, those comes under something called indirect tax. And EB tax is the indirect tax solution. Okay.
Okay. So even Sabrix is also indirect tax solution only, right?
So from an Oracle perspective, we have got something called EB tax module, but there are a lot of limitations with the EB tax module. If you want to get into complex kind of a tax calculation, EB tax is not helpful. So in those cases, most of the clients will go for something called Vertex or Sabrix. These are the external service provider, but they are certified with Oracle and they are integrated with Oracle. So especially in US, most of the companies go for Vertex or Sabrix. There are two reasons for that. I mean, of course, I'll get into those details when I get into that EB tax module. But the Vertex and Sabrix are used by most of the US clients because they are very good at the tax reporting as per your US tax law. So most of the US tax law requirements are made by your Vertex and Sabrix. You can very well directly run a report out of your Vertex. If you integrate your Vertex with your Oracle, whenever you are doing a data entry, the tax calculation of your VAT or GST will be calculated in Oracle and it will be automatically updated in your Vertex system. And at the end of the month, from a income tax reporting perspective, you can run the reports and directly give it to your taxation authority. So that is the reason why most of the clients go for Vertex or Sabrix. Oracle is still not properly matured from a tax perspective, and hence most of the customers in US are going for the Vertex or Sabrix. But at the end of the day, still we need to have kind of an EB tax layer whenever you do a tax calculation. Oracle, your subledger with your AP or AR, and then on that there will be an EB tax layer, and behind the EB tax layer there will be a Vertex integration.
Okay, got it.
Okay, so we have got two books, corporate book and tax book. So now we need to create these two books before we proceed with your fixed assets. So let me get into BR100. So obviously in all the modules, the first step is creation of the responsibility. Second step is assigning of the profile option. Third step is assigning of that particular responsibility to our user ID. So first we'll start with the creation of the responsibility. So we need to go to system administrator, security, responsibility, define. I had already defined this particular responsibility. So the naming convention is fixed asset super user Reliance INR. As I said that the fixed assets is at a kind of a ledger level. So I've used the word Reliance INR, and application is assets, responsibility key, any unique key. Data group will be always standard. And the menu, I have copied the menu from the normal your fixed assets vision operations responsibility. A request group also I just copied from there. So this particular FA main has got all the concerned FA related menus. So first thing is creation of the responsibility. Second thing is assigning of the profile option. So there is only one main profile option, which is the ledger. So as it is not related to any kind of an operating unit, there is no requirement to go for MO operating unit. Okay, straight away enter the GL data access set, which is Reliance INR ledger. Third step is assigning of this particular responsibility to my user, which I had already